What if I told you that a black painting could generate double-digit annual returns, but only if you ignore fees, liquidity risk, and who controls the exit? Today, we're breaking down the real economics of art investing, using a $1 to $2 million painting by Pierre Soulages as a case study. Is this a smart, long-term allocation, or just beautifully packaged illiquidity? Let's get into it. Pierre Soulages was one of the most important French abstract painters of the 20th century. His Outrenoir series, meaning beyond black, explores how light reflects off textured black paint. Top early works from the 1960s have sold for over $20 million. Here's the key distinction. The painting we're analyzing is from 2009, late in his career. Late period works trade significantly lower than prime 1959-1963 pieces. So when evaluating art as an investment, you must ask, are you buying the peak historical period or the broader market beta for the artist? Now here's where it gets interesting. Platforms like Masterworks allow investors to buy fractional shares in paintings. But you're not buying the painting. You're buying shares in an LLC that owns the painting. That LLC charges acquisition fees, ongoing management fees, and takes a cut at exit. There is no defined hold period. That means your return depends entirely on when the manager decides to sell. This is structurally closer to a single asset private equity fund with no maturity date. Segment 3. The soft market timing claim. 4 to 600. The platform claims they acquired this painting in a softer market. And yes, the art market cooled after the 2021 peak. But here's the real question. Did they buy below intrinsic value or just below bubble value? Buying 15% off the peak doesn't automatically mean you bought cheap. In illiquid markets like art, exit timing matters more than entry timing. If they can't sell into strong auction momentum, your great entry point doesn't matter. Segment 4. The numbers that matter. 600 to 800 card. Marketing materials site. 11 to 12% historical appreciation. A 0.56 Sharpe ratio. Strong repeat sale growth. But here's what most investors miss. These numbers are based on auction-only data, selected similar works, repeat sales, which exclude weaker pieces that create survivorship bias. And once you subtract fees, a 6% gross appreciation rate could become 3-4% net. Over a 7 to 10 year hold, that's a major difference. Segment 5. Who should actually invest in art? 8:00 to 9:30. Art can make sense if you want low correlation to equities, you're comfortable with illiquidity, it's under 5% of your portfolio, you're allocating for diversification, not alpha. It likely does not make sense if you're seeking higher returns than private credit, you need liquidity, you're comparing it to traditional private equity. Art is not a yield strategy. It's a patience strategy. The painting may be beautiful. The artist may be iconic. But investing isn't about beauty. It's about structure, liquidity, and risk-adjusted returns. Before allocating capital to art, ask yourself, are you buying the asset? Or are you buying the narrative? If you found this breakdown useful, subscribe for more deep dives into alternative investments most people don't understand.